All right, 6:05. We are going to start our meeting. So we have lots of people in the room. Thank you so much for coming, everybody that's here. We have a lot of people on Zoom as well tonight. So welcome everyone that's on Zoom. I am Kelly Slaught, the CEO, president, founder, radio show host. Boy, I can't speak. And I have a radio and audio. So welcome everyone. I'm going to go to the next slide. No, I'm not. There we go. Okay. Tonight's presentation. Welcome everyone. We are going to be talking about, we have a speaker tonight, Robert Bomberg. I'll introduce him in a second. Catalyst Millburn strategy hedge fund that we're going to talk about tonight. So welcome to him. He's on my side here. He'll be up here in just a moment. So I like to bring in different speakers, as you all know, to talk about different products because there's a lot of different things out there. I love to educate. So that's why I do these meetings. So again, welcome. And I'm glad you're all here. I do have these meetings periodically. The next one will be on May 9th. I will have it either live in my office if you'd like to come to my office or via Zoom like we're doing here tonight. So May 9th will be on Pacific Oaks Smart Stop seminar. That is an alternative real estate program. So many clients that I have that are on the call tonight in the room are in that program, and we've been delighted to have you join us for that. We will send out you invitations for that. You can also register for that on my website, californiawealthadvisors.com. I do have that there to register. Also, my book is on my website here for people Zooming. I do have my book, The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. I think that's a really important book for educational purposes and strategies to make sure you're doing the right thing for your portfolio. Good for not just retirees, for pre-retirees, retirees, or post-retirees as well, because I do have 6 big blunders in there that I see people make a lot, and I want you all to avoid those. So that's something to look at as well. Okay, tonight, we are going to talk about the Catalyst Millburn Hedge Fund, and that is in the red section there. I don't usually have a lot in the red section that I talk about. A lot of times people are interested in learning about the alternative space, that light blue space, the A of my mass proprietary process, or the S, the safe money, the dark blue in my mass proprietary process. But tonight we have the red, because I wanted to bring Robert in to talk about his hedge fund, because I want to have people aware of different alternatives to the market, to the stock market, the regular stock market, for instance, buying IBM or AT&T or something like that. How do we take advantage of maybe downward trending markets? So he'll go into that for you. Again, the red section is what we're going to talk about tonight. The meeting in May will be in the light blue section. That's on the real estate section, just to give you a heads up for that. So again, I love diversification. That's the number one thing I talk about with people. Number 2 is to have a plan. Make sure that when you have a portfolio, you're diversified. Having diversification in your portfolio is absolutely key. And of course, having a plan and sticking with your plan. We don't panic with the markets. Markets go up, markets go down. We have a plan, we stick to it. And I do it through the mass proprietary process. So all of my clients on the Zoom meeting and in the room here know this is what I like to do. It works really well through a lot of different kinds of markets that we see coming our way. And again, I've been doing this for a very long time, and to have diversification is absolutely key with that. Okay, so those of you new to me, I wanted to go over again my wealth management process that I do, especially for new people. So the first meeting that I have with you is going to be to establish a relationship. Can we work together? Am I bringing to the table what you're looking for? I'm going to be asking you a lot of questions about your portfolio, what you're trying to do, your risk tolerance, your time frame, all of that. So all of the people in the room are going yes, because they know that's exactly what I've done with them. The second meeting, or the second development stage, I should say, is to really have me develop a strategy for you to take what you tell me and really for me to think about it and create that master proprietary process for you specifically. And we tailor make our strategies for you. And there's no cookie cutter here for you at all. Third step, we're going to have an investment meeting, talk about what you told me, what I came up with, show you the plan of what I suggest for you specifically. Number 4 is going to be implementing the plan. That's signing the paperwork, doing transfers, whatever we need to do to get you moving there. Number 5 is to follow up, and I'm very well known at that, to have follow-up meetings to say, this is what you did, this is where everything is right now, and you will be getting statements to show all of that as well. So number 6, develop and manage your plan. But really number 7 is, I think, one of the most important steps I have on here, and that is ongoing review of your portfolio to make sure your portfolio is doing what you want it to do, that it's where you want it to be, your risk tolerance is correct for you. And we do these every 6 months or so. My staff, of course, is available any other time that you need a question answered, a statement or something like that. But to do a deep dive into your portfolio and what's going on with it, we do those religiously because we want to make sure everybody's on the same page. And I'm very well known for that. My staff is very good about setting up those meetings because I am a very hands-on advisor. I want to make sure what we've done for you is correct for you. Okay, so there's my process there, just to remind all of you or any new people we have watching tonight. Okay, with that, I am going to introduce Robert Bomberg. He is our speaker tonight. He's a representative for Catalyst Millburn. And here he's got his strategy fund fact sheet on the table here. I got to hand him the microphone. And then questions we will have towards the end. If you are on Zoom, you can always type them in and I will be watching that and maybe answer some of those as we go along. But if you want to save some of the questions towards the end, that's fine too for everybody in the room here. Okay, with that, I'm going to introduce Robert. There you go.
Thank you so much, Kelly. The sun here. Thank you for having me. Yeah, we would need to adjust the camera just a little bit. How's that? Okay. In the middle. Okay, I wasn't sure if I was blocking the fact sheet up there. Understood. Well, good evening to everybody who's live in the room, and good evening to everybody who's here on Zoom as well. Appreciate your time and the interest here. I'll just do like a little kind of 60-second commercial on myself and my background, and then we'll dive into sort of the meat and potatoes of what we're here to talk to you about tonight. So as Kelly mentioned, my name is Robert Bomberg. I'm actually born and raised in Minnesota. I went to college in the University of Wisconsin-Madison, studied abroad in London for a little while. And then upon graduation, actually became a 5th grade elementary school teacher for a year on the south side of Chicago. As much as I loved teaching and working with the little kids, I decided financial services was ultimately my calling, and I got into this industry in about 2002. Fast forward to today, I'm actually a self-employed independent business owner. So what I do is I go out and I search or hunt what I think are some of the best boutique asset managers in the country that just don't have distribution. So if you think about some of the big asset managers out there, BlackRock or PIMCO or Fidelity, they've got probably 300 people just like me that run around the country and talk about their mutual funds or their SMAs or annuities or whatever their products are. I rep a handful of different mutual fund companies. My biggest one and my flagship product is called the Catalyst Millburn Hedge Strategy Fund, which we'll get into here in just a little bit. Some of the topics of conversation here are going to be something called artificial intelligence and alternative investments, and how artificial intelligence plays a role in into alternative investments, specifically the Catalyst Millburn Hedge Strategy Fund. So let's open up here with just a little bit of trivia for the group. And I know you folks on Zoom, I don't know if you'll be able to chime in, or I'll just keep it to the folks in the room here, but I'm going to open up with a trivia question. And I mentioned the fund company earlier, which is called Fidelity Funds. Does anybody remember Fidelity's flagship fund in the 1970s or 80s? Anybody remember what that fund was called? But it's like, yeah, so I'll tell you, it was called the Fidelity Magellan Fund. Okay, Magellan Fund, I don't know if that rings a bell. I believe at one point it might have been the largest mutual fund in the world. Trivia question number 2. So what was the portfolio manager's name who ran it? Anybody, does that name ring a bell? That one might be a little trickier. His name was Peter Lynch. Peter Lynch ran the Fidelity Magellan Fund. It sounds like you remember that one, yeah. Trivia question number 3. What years specifically did he run the Fidelity Magellan Fund from? This is the interactive portion of the presentation, so feel free to chime in with any guesses on the years. Yeah, I gave you a hint on that earlier, so you're correct. Specifically, it was 1977 to 1990. So about a 13 or 14-year run that he ran the Fidelity Magellan Fund. Next trivia question. What was the average annual return of his fund during that 13 or 14-year stretch? 13% is what she said in the back of the room. It was actually significantly higher. It was actually about 29%. Okay, yeah, 29% is what he averaged per year. Now here's the follow-up trivia question to that. What did the S&P 500 average over the same time frame? Say your answer this time. Pretty close, about 14%. So there's a reason why Peter Lynch is a legend and why here we are in 2023 and I'm still talking about him all these years later is because he did 29 while the market was doing 14-ish. But here's the real trivia question, then the last one. And Fidelity actually did an entire case study on this. What did the average client experience who played with this fund, meaning they traded in and out of it? Any guesses there? The answer is approximately 3%. That's it. You've got the fund doing 29, the market doing 14, clients doing a 3%. So between 3% and 29%, you've got about a 26% discrepancy. Why the gaping hole? I think a lot of folks could probably guess it has something to do with nope, not commissions or fees. Those were net of fees. It has to do with investor behavior. People have a tendency to buy high, sell low, and do a lot of the wrong things at all the wrong times when they're left to their own devices. This is why it's so imperative that you work with, a professional financial advisor, i.e. Kelly and whatnot. So they oftentimes will keep us from our own worst enemies, which are ourselves. And so I bring up that little mini case study on the Fidelity Magellan Fund, and just think about that as I present what I'm going to talk about here in our fund, because I'm going to kind of tie it all back in a little bit. So the Catalyst Millburn Hedge Strategy Fund. I'm just going to grab the fact sheet here. I know it's up behind me as well. I'll do a little, again, 60-second commercial on who is Catalyst Funds and who is Millburn and what the relationship is before I dive into the components and the portfolio composition. So Catalyst is the name of the mutual fund company. If you haven't heard of Catalyst Funds before, they're much smaller than your PIMCO, Fidelity, Oppenheimer funds or whatnot. They're probably around the $8 or $9 billion mutual fund manager now, and they have somebody called a sub-advisor who is the portfolio manager who runs a specific fund. That sub-advisor is called Millburn. Millburn isn't one person. Millburn is like 75 people. They have offices in New York, London, Connecticut, and Shanghai. In this particular mutual fund, and by the way, that's what this is a plain vanilla 40 Act mutual fund with daily liquidity and a 1099. There's no K1. There's about $5.8 billion in the fund, and a good chunk of the assets in the product are proprietary capital, which means the portfolio managers, the analysts, the traders, yours truly, we eat our own cooking. We have skin in the game in a pretty significant way. So we really believe in what we're doing. And that, by the way, I can kind of pick and choose which funds I'm going to represent, which ones I'm not. And that's really one of the main criteria for me in my vetting process and checking off boxes is, am I going to put my own money in it, my wife's money in it, my parents' money in it, I have a 3-year-old daughter, her money in it? And if the answer is no, then I'm probably not going to rep it and add it to my quote unquote bag of bags that representative. So on if you intuitive version of I shouldn't care about what I'm about to tell you. And it really starts here on the front of this fact sheet, where you see this track record. So from 1997 to today, what you're looking at is 26 years worth of real live actual returns. Okay, it's audited returns. It's not a back test. It's not a hypothetical or anything like that, whereby you can see it only has 3 losing calendar years. 2020, it lost 49 basis points. 1 basis point is 1/100th of 1%. So it's about 0.5% it lost in 2020. And I'll apologize in advance here because I'm probably going to throw out some investment terminology or lexicon. And if there's something that I say that you're not familiar with that verbiage, again, please feel free to chime in, whether you're in the room here or on Zoom, and I'll give definitions for anything that's needed. But so down 49 basis points in 2020. 2018 down 2.16%. So that'd be 216 basis points. And then the only other losing year was 2011, where it lost 7.2%. So 3 losing years out of 26, pretty good. But more important than that, by the way, all single digit losses, more important than that, I look at the last 4 or 5 calendar bear market years and see how did it do when it was tested, when it's almost pseudo time to sort of go to war in either a recession or a bear market. And you can see in 2000, 2001, and 2002, that was known as the tech wreck. In all 3 years of the tech wreck, this fund provided positive returns. In 2008, during the Great Recession, the fund was up 5.33% net of fees, whereas the S&P 500 was down 37%. I see a lot of heads shaking north-south, like you remember that, and this would have been nice to have back then. And then again, last year, 2022, we didn't quite hit the technical definition of a bear market. In 2022, the technical definition of a bear market is 20%. I believe peak to trough at some point in the rolling 12-month frame, we did hit that. But you can see the S&P was down 18.11%, and this fund was up 7.72%. So this provided what we like to call, crisis alpha, meaning it zigged when the market zagged. It provided positive line item, attribution on your statements. It helped in the more challenging times. If you look down below that, you'll see since inception, the fund has averaged 10.61% per year versus the S&P 500 at 8.53% per year. So it's beating the S&P 500 by about 200 basis points per annum back to 1997, which is all well and good. But if I'm in all of your shoes, the question I want to know is, well, that's great, Robert, but how much risk are we taking to generate these returns? And if you look at the back of the fact sheet in the upper left-hand corner here, this is, thank you, Kelly. Yes, yep, the back of the fact sheet here in the upper left-hand corner, you can see the MPT stats. MPT is, again, more investment lexicon. It stands for Modern Portfolio Theory. And I'm just going to give some very rudimentary, kind of one-sentence definitions of these. So alpha is essentially the portfolio manager's value add. It says, okay, according to, how much risk a portfolio manager took, how are your returns? Typically anything north of like 2 or 3 is considered a good alpha. You see it north of 6, and that's outstanding. Beta, in a 2-word definition, essentially measures what's called systematic risk to the S&P 500. So the S&P 500, by definition, always has a beta of 1.0. So you can see in here that this fund has a beta of 0.48, which tells you it has about half of the systematic risk of the S&P 500. So again, it's beating the market by 200 basis points with approximately half of the beta. And then down below it, to me, R squared is perhaps maybe one of the more important MPT and overlooked MPT stats. And it's a measure of like variance or correlation to the market. So again, by definition, the S&P 500 has an R squared of 1.0. So if you invest in a stock or a mutual fund that has an R squared of 1, it means it moves perfectly in tandem with the market. If you have one in this case that has an R squared of 0.24, it tells you it moves very little to the market. It's disconnected or uncorrelated. And I want to stress that word uncorrelated or non-correlated, because sometimes it gets confused or conflated with negative correlation or inverse correlation. So inverse correlation or negative correlation would essentially mean, if the market goes up, this fund or product would go down. Conversely, if the market goes down, this fund or product would go up. At a 0.24 to the S&P 500, what it's telling you is that it has very low sort of variance or correlation to the S&P 500. It means the market could go up, this fund could go up, it could go down, or it could go sideways. Conversely, the market could go down, and this fund could go up, down, or sideways. Kind of anything is fair game on any given day. Also not listed on the back of the fact sheet here, perhaps I should have it added, is that the fund also has an R squared of a straight 0 to the bond market, the Barclays aggregate, which is essentially the equivalent of the S&P 500, but on the fixed income or bond side. So What that tells you is that this fund not only has low correlation to the equity markets, it also has very, very low correlation or connection to the bond market. And why that's pretty important is, I'll use 2022 as an example. 2022 was the first time in 150 years when both the stock market and the bond market were down north of 10%. The stock market, defined as the S&P 500, was down about 18, and the bond market, defined as the Barclays aggregate, was down about 13%. First time in 150 years that had happened. So what that also means is that your traditional 60-40 portfolio, if you were invested 60% stocks, 40% bonds, that, you know, in most any other year would be considered well diversified, didn't do its job, not even close. You were still down somewhere between 13 and 18% in 2022. By adding in a bucket that I would call liquid alternatives, inside this bucket of liquid alternatives, things that zig when the market zags, go products like the Catalyst Millburn Hedge Strategy Fund. You know, this was up 7.72% last year. It's something that would have kicked in for a little bit of a cushion or sort of seatbelt or airbag, is to help out with some protection. A lot more about what's under the hood here in just a second. Maybe let's take a quick pause and see if there are any questions before I dive into anything. Just keep going, Kelly. Okay, let's go to the. So this is the brochure for the mutual fund. I'm going to skip over the cover. I'm going to skip over, because I already talked a good chunk about the manager with deep experience. So, you know, Millburn, I mentioned their roots go back to 1971. Their, you know, claim to fame is, I believe they were actually the first CTA, commodity trading advisor, or first managed futures managers in North America. So they've been doing this for a very, very long time. Actually, let me back up one here. So you can see on the back of the fact sheet here on the right-hand side, there are 3 listed portfolio managers who run the fund. And I think this is important to share that, you know, they've been doing this not only since the inception of this fund back to 1997, they've actually been with Millburn, the sub-advisor, much longer. So you can see Barry Goodman, he's been with Millburn since 1983. Grant Smith has been there since 1975. And Harvey Becker has been there since 1978. So it's a very deep and experienced group. These are the 3 listed portfolio managers. There's also an investment committee at the firm of approximately 15 people. And then, like I mentioned earlier, there's roughly, I believe it's 75 people in the firm as a whole. Okay, the strategy. So what are they doing? What's actually under the hood in this product? If you look at the top of this brochure on page 3, you'll see this Venn diagram. And the Venn diagram obviously is 2 overlapping circles. And I use that to show that it's essentially 2 strategies or 2 buckets in one mutual fund. So bucket number 1 is on the left-hand side of the Venn diagram, where it says active long short managed futures. Bucket number 2 is on the right-hand side of the Venn diagram, where it says strategic equity exposure. So let me dive into just each of them a little bit. On the right-hand side, strategic equity exposure, that's going to coincide with the 2 columns down below where it says diverse portfolio, and, you know, underneath that, passive long static equity exposure. So ETFs. So ETFs, for those who aren't familiar, exchange traded funds, sort of like mutual funds, but they trade on a daily basis. So you get 40 different ETFs in this portfolio. The 40 ETFs are from, you know, names that you're probably more familiar with: BlackRock iShares, Vanguard, Charles Schwab, and WisdomTree. These ETFs, they're passive in nature, they're static, they're buy and hold, they're long only. They're essentially just there for sort of what I talked about earlier, beta exposure, to give you some participation in the upside of the market should the market go up. On the left-hand side of the Venn diagram, it says active long short managed futures. That's going to coincide with the columns down below it, all to the left of the ETFs, where it says active long short managed futures. So if you take a giant step back and just say, what's the overall goal of this fund with these 2 buckets? I like to look at it as, it's essentially, you've got 2 buckets. One bucket is sort of playing offense. That's the ETFs. It's designed to participate when the markets go higher. And the other bucket is designed to play pseudo defense. It's designed to be your seatbelt, your airbag, your cushion, your safety net, whatever analogy you like to use when the markets are maybe not going as well. And the beautiful thing is that when you blend or marry these two baskets together, they have very little correlation or connection to one another, such that they end up playing pretty friendly with one another in the same sandbox. Okay, so let's unpack this a little bit more. The two buckets. If you put $1 into the fund today, where does your dollar go? 50 cents, approximately 50 cents of every dollar goes to these passive long-only ETFs on the right-hand side of the ledger. The other 50 cents goes to the futures contracts on the left-hand side of the ledger. Now, the fund has embedded leverage in the portfolio because these are futures contracts, which means that 50 cents on the futures side actually trades closer to 75 cents, maybe even 80 cents. So that means for every dollar you invest in the fund, you're actually getting about $1.25 or $1.30 perhaps worth of overall exposure. And why that's important is because the future side of the ledger is typically what makes you the money in the more challenging years, in the bear market years, i.e. 2000 to 2002, 2008, and 2022. The problem that I've found with only investing in a pure futures fund and not having the equity component to blend in, and I'll ask this question just rhetorically to the group, because I ask financial advisors all the time, what's the number one biggest problem with a pure futures product? And I'll hear all sorts of responses such as, well, they have high fees, lumpiness of returns, trend following maybe doesn't work. I would say perhaps all that is somewhat true, but the bigger problem goes back to what I talked about earlier, the investor behavior issue, is that everybody needs a futures fund in 2008, and typically nobody buys them until 2009. You end up being a day late and dollar short. And that was really what Millburn, the sub-advisor, kind of noticed, because they ran a limited partnership, a pure hedge fund for many years in the 1970s and 80s that was just on the left-hand side of the ledger. What they found is it works really great over the long term, and has a great long-term track record, and particularly works well in the bear market years. But guess what? The market's going to up approximately 7 out of every 10 years, sometimes 8 out of 10 years. So if you're only investing in that left-hand ledger, you're invariably stacking index too. And so that I keep in mind in 1977 that Millburn came in and said, why don't we add a long-only passive component to the portfolio in these ETFs? And what it should do is help to smooth out the sequence of returns just long enough so that investors don't hit the panic or eject button. They stay in it when they need to be in it. Okay. If I go back to the fact sheet here for a second, I went the wrong way. I'm going to talk about these rolling 36-month analysis on the back here. And I think these stats are pretty compelling. And there's a great quote. I don't even know who said it, so I can't give them credit, but I steal the quote all the time. And the quote goes, if you torture the data long enough, it will confess to anything. And so we did that. We tortured the data, and what we found was some pretty interesting statistics. So what you see here in this rolling 36-month analysis is that if you can hold on to this fund for 36 months, in other words, 3 years, look at what happens. If you look down to the profitable periods, 97.83% of the time, you're profitable, you make money. Approximately 2% of the time, you lose money, you're unprofitable. And then down below that, the average unprofitable period when you do lose money, it's 1.05% versus the S&P 500 that when it loses 7.53% over the same time frame. So the moral of that story is that statistically speaking and historically speaking, if you all have a 36-month time horizon or a 3-year window, there's essentially almost no bad outcome. It shows that it's about a 1% loss over any rolling 3-year, 36-month time frame over the last 26 years. I know there's a lot of numbers and data in there, but hopefully that all made sense to 2 or 3 of you in the room. All right, back to this, and how am I doing on time? Okay. Get back here. All right, so what is Millburn's competitive advantage or edge, it really has to do with the left-hand side of the ledger in futures. That I mentioned is their core competency. They've been trading futures contracts since the early 1970s. But as technology has gotten better from the 70s, 80s, 90s, and today, a lot of that has now been implemented into the strategy in the form of AI, artificial intelligence, also known as machine learning, also known as statistical learning, also known as smart algorithms. And AI is this incredible buzzword that you really can't turn on the TV, CNBC, 60 Minutes, Jeopardy, whatever, without hearing something about artificial intelligence these days. So let me just provide everybody with what I think is the best single sentence definition of AI. This is where the machines, the models, or the algorithms can actually teach themselves to get better with time. And in other words, when the machine is broken, it can fix itself. And sort of the best example of this is what the big technology companies have been doing for the last 15, 20 years. And I think about Google, I think about Amazon, I think about eBay, I think about Facebook or Meta, I think about even like a company like Netflix. And the reality is anytime any one of us logs onto the internet, what are we doing? We're leaving this digital footprint behind us, whereby somebody's tracking and monitoring what websites do we go to, what time of day are we there, the duration of how long we stay, how many clicks we make, et cetera, et cetera. And why are they doing this? They're tracking our central patterns of behavior, our central tendencies. And why are they tracking that? They're tracking that so they know what to market, what to advertise, and what to sell us. I mean, how many times have you been talking about something out loud to a friend over the phone or in person, and then you go into Facebook or whatever social media site you choose to use, and voila, you see an advertisement for it 2 seconds later. Question right there. Sure.
Take care of, and what pops up in my email, an advertisement for pet insurance.
Pet insurance.
Blue.
It never fails. So somebody from the live audience here just cited a specific example of this where they were going to the veterinarian's office and they're sitting in the waiting room talking for, what did you say, an hour or two? And sure enough, right after that, you got an advertisement while you were there. Actually, you got an advertisement for pet insurance. And so they're listening, they're watching. And it's really, at the end of the day, it all comes down to money. Our fund, the Catalyst Millburn Fund, implements artificial intelligence into the process. And I'll get into that here in a second, but I want to provide just a couple other anecdotal examples of where AI is being used in everyday life that you might not even think about. Go ahead, one.
To be the best chess master in the world.
Yes. So he made the comment about to beat the best chess master in the world. So a grandmaster would lose. I don't play chess, I don't speak that lingo, but I would imagine lose in great magnitudes against the machine. So Netflix, 10 minutes. Okay. All right, I gotta cut this down. So Netflix, believe it or not, Netflix could be a mini case study on artificial intelligence. And one show in particular I'm going to draw example to is the television show House of Cards. By show of hands, who's familiar, seen it or familiar with the show House of Cards? So typically, if you're a Hollywood producer, director, etc., and you're going to film a new TV show, how do you film it? In the old world, you'd film a pilot episode and maybe one or two more, to make sure that the show is a hit, it's a success. That's not how they typically do things anymore. And specifically, the show House of Cards a few years back was one of the first to do this, where they didn't just film the pilot episode, they filmed the first 3 seasons out of the gate. And why did they film it that way? Well, because they use their own internal analytics, their own machine learning or AI to determine a few things about their audience. And what did they determine was this. Number one, the recipe for a successful show was to blend or marry politics with corruption with Kevin Spacey, the actor, but before he had his legal troubles. And if they had married those 3 things together, they knew they had a winner. And so they filmed as many of the shows in the first few seasons as they possibly could because it's so much more cost efficient to film them that way. Think about it, when you don't have any scheduling conflicts amongst the actors, you don't have, wage negotiation disputes. And the example I'll give to all of you is everybody, I'm sure, remembers the television show Friends on NBC.
Yes.
The trivia question there is 6 friends, and the final season, what were each of the 6 friends earning per actor per episode? Yeah, the answer, he said it over here, it was $1 million per actor per episode. But the real trivia question, and I had to Google this to find it, what were each of the 6 friends earning per episode per character in season 1? You're in the ballpark. He said 50,000. It was like $23,000 or $24,000. So just imagine if you're NBC producers, if you could have locked up Courtney Cox and Jennifer Aniston and whoever else was in that show for 10 years down the road at $23,000 an episode versus $1 million, it would have been a way to save tens of millions of dollars. So my point being is that they're using this artificial intelligence and machine learning across Hollywood. They're using it in science. They're using it in medicine. They're using it in sports. It was really only a matter of time before it became in the forefront in the investment community as well. And Millburn, our sub-advisor, is actually really known to be a pioneer in that space of artificial intelligence. In fact, an independent journal called the Hedge Fund Journal, I don't know if anybody's familiar with them. I think they're out of Boston, but don't quote me on that. They wrote not 1, not 2, but 3 separate articles on Millburn's AI capabilities and how it's kind of changing the game. And what they can do is really trade their underlying securities with a lot more data and a lot quicker and more response time than they ever could before. They'll actually look at the world essentially in these 5 to 15 minute windows and can trade accordingly. So I mean, you look here, just a little futures 101 says there are 6 broad categories of futures trading. 3 that are financial and 3 that are non-financial. So your financial futures here are interest rates, currencies, and stock indices. Your non-financial futures are agriculture, metals, and energy. Millburn trades all of them. There's roughly 125 of these futures contracts. They can trade them long, they can trade them short, or they could do nothing with them, just leave them alone. And then with their AI, they can trade them in these, kind of 5 to 15 minute windows. It looks like there may be a comment or question right here.
What's the average?
So the question was, what's the average length of a futures contract that they trade in? I can't give you a precise answer because it's always a moving target, but I can tell you it's short. They trade the front month or the near month contracts. So here we are in, what are we in April? So we're not trading anything, typically out in, May, June, July. It's, this next month is where we're trading. And sometimes we might have a position on for a month. Sometimes it might be a week, sometimes it might be a day, and sometimes it might be intraday. And so what they'll do is essentially ranking, the algorithms will rank all of these securities from like a +100 to a -100. The closer you are to a +100 is a high conviction signal to go long the underlying security, the underlying futures. The closer you are to a -100 is a high conviction signal to go short that underlying security. Closer, if you're in the middle, it's a neutral, and they don't take a play on it conviction-wise one way or the other. They'll just leave it alone. But the beautiful thing about artificial intelligence is what they're doing is essentially programming the computers for almost every single combination or permutation of a what-if scenario. What could happen at anywhere in the world at any given time that could move the markets? And in the 26 years that this fund has been in existence, I would say there's probably only been a couple of times where the algorithms got spooked, so to speak, and didn't necessarily know what to do or what to trade. It's not that they didn't know what to do, but where they lowered their conviction and just said, let's just kind of take a little time out here. And the 2 periods of time where the algorithms hadn't been programmed for, one of them was fairly recently. It was March of 2020. So everybody kind of remember what happened in March of 2020. This is COVID. And even though in years and decades past, we'd seen several infectious diseases, bird flu, swine flu, SARS, et cetera, and in the past, the markets had shrugged them off. Maybe the markets went down for a day or 2 and then decided it was kind of a nothing burger. Well, that's what started with COVID-19. I mean, COVID-19 is the 19 suggests started in 2019, and the markets didn't really think much of it until March of 2020. And all of a sudden, we saw this peak to trough drawdown in the S&P 500 by, Kelly probably knows the stat better than me, roughly 30%. Does that sound about right? And so our models, we didn't have that programmed into the computers to say what happens if there's a worldwide pandemic or epidemic, because even though we'd seen pandemics or epidemics in the past, the markets didn't care. This time it cared. Well, now we bake that into the models. What happens if there's infectious diseases? The other period of time where the algorithms got, like I said, maybe a little spooked was, sadly, September 11th, 2001. And everybody probably recalls vividly the unfortunate horror and terror from that day. And the algos, the human beings didn't program the machine for a what if scenario. What happens if a terrorist takes a commercial jet engine plane and flies it into the side of the buildings? When that happens, the machine didn't know what to do. Sadly, the machine has some idea of what to do because it's seen it before and it learns from the past patterns from their behavior. So right now, I've heard there be something now. There's someone that if you haven't thought of, I don't know what that is. If you see it next time, we'll know. It's an asteroid, he says. A zombie apocalypse, perhaps. I don't know, but the point being is, I wouldn't say this is not an end-all be-all fund, but you get a lot of diversification with it. That's paramount to Kelly's practice. When you buy this fund, you're owning 125 different futures contracts, and you're owning large cap and mid cap and small cap equities. On the ETF side, you own a little bit of real estate with the 2 REIT ETFs that are inside of it as well. You just get an overall nice fund. It's not to say that it can't lose money and it can't go down. It definitely can. It can have a 10, even 15, maybe an 18 or 20% drawdown, peak to trough at some point in a year. If and when it happens, I guess our portfolio managers are pretty adamant about the fact that it will happen, and try not to hit that panic or eject button. They run the portfolio at a standard deviation or targeted volatility such that we expect that. But again, over that rolling 36-month time frame, we expect to get solid returns. So let me pause or stop there because I think I'm probably just about up on time. And do we want to open it up to? I have to look at that. Yeah. So Kelly asked to cover kind of the minimum investment and dividends. So we have it listed on the back of the fact sheet as a $2,500 minimum. Don't quote me on this, but I believe we will accept lower amounts as well. But I think that's the stated minimum. And then once you've met that 2,500, then subsequent investment is zero. You can put a penny in or whatever you like. It's not a dividend or a yield play per se. It is a capital appreciation style of fund. That's not to say that there is actually a small yield right now, because there are some with futures contracts, treasuries that are involved. And if you would have asked me a year ago, the yield would have been zero. In today's world, bonds and treasuries are meaningful, and you're actually getting paid on the yield curve a year or two out. So there's a modest yield right now. I think it's maybe around 2%, but I really wouldn't set that as an expectation. It's not a yield fund, it's a capital appreciation fund. Was there anything else that you wanted me to specifically address, Kelly?
Thank you, Robert.
You got it. Thank you all. Appreciate it. Yeah, should we do? Sure.
Go ahead.
Okay, great question. So what is the definition of a hedge fund and what are the fees for this fund?
I'm gonna let you take it.
All right, well, I'm gonna let you do it.
Well, we'll start with the reverse chronological order because the latter is easier. So the fee on the product on the iShare, and Kelly would know more about what share class is appropriate for each individual, but it's 2.02%. So roughly a 2% expense ratio or fee on the fund. I'll be the first to admit 2% mutual fund is not the cheapest product out there in the universe of low cost ETFs these days. However, 2 points, keep in mind. Number one, the returns that you see on the front of the fact sheet they're not only a net of that expense ratio, they're also net of a 20% carry or a 20% incentive fee that they used to take from 1997 to 2015 that they dropped. So as expensive as it is now, it was actually way more expensive approximately 7 years ago, 8 years ago.
So I've got up here on the chart for people that are zooming, the returns per year. Is that net of fee? Is that gross of fee?
So from it's net of fees for the whole way. And from 1997 to 2015, it's net of 2% expense ratio and a 20% profit taking fee, which again, they don't take the 20% profit taking fee anymore. And then from 2016 to today, it's net of just the 2.02% expense ratio.
Okay, so when I do these, George, just so you know, I do the iShares for people, and that is the lowest expense fee share class that we can get for you. Okay, and then why don't you explain what a hedge fund is, and then I'll have my closing remarks.
Okay, what is a hedge fund? My goodness. So a hedge fund to me is typically in a wrapper of something called an LP, a limited partnership. And so you think, well, first, who the biggest hedge fund in the world last time I checked is Bridgewater, Ray Dalio's company. The second, I think, is the Man Group that's out of the UK, and then third, I believe, is Renaissance Technologies Fund. So these are funds that hedge. In other words, they use derivatives. So it could be a futures contract, it could be options. They can trade things long and short. But the idea is, for every long position on, you have a counter offsetting short, which hedges your position. One side tidbit on Renaissance Technologies Fund, because sometimes I do get a little flack about our fund being expensive. Last I heard or checked, the fee on the Renaissance Technologies Fund was like 5 and 50. 5% expense ratio plus 50% of the profits. And I believe they have a line wrapped around this building 10 times over to get in, because they're really good, really good at what they do. So we're actually a lot cheaper than some of the other ones that are out there. And we're not technically a hedge fund. It used to be a hedge fund in an LP wrapper. Now it's a plain vanilla 1940 Act mutual fund, which means we have daily liquidity. There's no lockups, there's no K1s, there's no subscription agreements. It's just a lot easier for Joe and Jane Smith client to own our fund than a classic hedge fund.
That explains why hedge fund.
So his comment was that explains why hedge fund managers have such fun. Ray Dalio and others do have a lot of money, and that's why the carry.
Well, here's how to look at it as well. If they weren't making money for the clients, they wouldn't be making any money themselves, right? So I try and talk to people about commissions and fees, and I do that every time I sit down with someone and recommend a product. I don't get caught up in fees. I get caught up in what is right for you. Is it the right investment for you? And again, of course, I am a fiduciary. I am always going to put your needs above anyone else's. But if an investment is good for you, it's good for you. And the fees will figure themselves out later. So that's how I look at any kind of product I'm showing you. It's like some are going to cost more than others. They just are. We don't do things for free, and we shouldn't, right? But I'm looking at the total rates of return. I'm looking at diversification, which is what I started this whole seminar with tonight, is this is a nice hedge fund, hedge being, what are we doing other than the market? To having your 401k, for instance, 100% in the stock market. Well, you're not hedged, you're 100% in the market. This is a way to do something a little different. And this is why I talk a lot about my master proprietary process, and I talk about the markets. That's the M part. That's where the hedge fund is here, and 401ks and IRAs that I see that are in the market. And then the alternative space, of course, many of you in here love that. And then S, the safe section. So when I do all three of those, it tends to bring people peace of mind and comfort in their portfolios, because they know they're not 100% tied to the stock market. So this is just another way of not being 100% tied to the stock market, or do it in a different way that is liquid. We can go in and out of this whenever we want, which is nice. So with that, thank you, Robert. I appreciate you speaking tonight. I do want to throw in, let's see if this goes. Let's go to the end slide here if I can find it. There we go. Okay, so thank you all for attending. I appreciate it. Again, the people in the room and the people on Zoom, I encourage you, please fill out the seminar evaluation form that is in front of you. If you can, I'll fill that out. Give us any information that's pertinent to you. If you're interested in this fund, let us know. If you're interested in something else we might be talking about, if you want to come to the next seminar that we're having, which is May 9th, please put that on your seminar sheet. People that are on the Zoom, we will be emailing these to you. So we definitely appreciate getting back to us. Our Zoom meetings, we're trying to always improve. So if there's something here that we've done, the lighting wasn't great, the sound wasn't great, please put that on your evaluation form. We highly appreciate any kind of comments, good or bad, to these seminars that we do. We want to make them so they're beneficial for you. So tell us if we need to improve something, or maybe we did something good. So tell us that too. So again, my next seminar, May 9th, here in my office or on Zoom, that will be on the alternative space, the real estate space. And very important for many of you to listen to that, to educate yourself on investments that are not in the stock market. So with that, thank you, Robert. Appreciate it. Thank you, everyone in the room, for coming. Everybody on Zoom, thank you for coming. We appreciate it. And by all means, give us emails. My email here is kelly@californiawealthadvisors.com if you have any questions or comments for that. But thank you. I appreciate it. Have a good night, everyone.